Good morning, everyone, and welcome to the Sirius Report. My name is Ken Shorgen, and as always, I'm here with Paul. And Paul, it's kind of fascinating to see President Trump in the first few months of his administration because he is channeling his inner Volcker. And by that, I mean he recognizes that something major has to be done to fix the economy, perhaps by allowing it to crash. Paul, as always, I want to thank you for being a part of the discussion. And I know you got some thoughts on this.
Yeah, well, thanks for obviously joining today as well, Ken. It's obviously a pleasure as ever. Yeah, we thought this was interesting because there's been statements coming out uh, from the Trump administration where basically it's like, well, in 6 months or 12 to 12 months, this will be Trump's economy. It won't be Biden's anymore. Now, why make that statement? And, mutterings about obviously the fact that there's weakness in the US economy and we're not concerned about various decisions that may impact the economy. And the question, therefore, is the Trump administration maybe not exactly trying to crash the markets, but not doing anything to stop that happening? Now, that is an enormous gamble because, you know, markets are, you might have at one point in time gone, it doesn't matter. And it didn't, but financialization, and ever since 2008, everything's predicated on asset bubbles because balance sheets need asset bubbles. If you don't have it, and that bubble starts to burst, then you have technical defaults, you have insolvency. And we saw this with the so-called medium regional banks when we had the problems with bond markets and they were in technical default. They had to, well, loads of them had to be bailed out and some went bust because they weren't in a position to be able to remedy the imbalances and that existed on their balance sheet, because a lot of financial institutions' balance sheets all hinge on having markets just inflated all the time. So the question is, if you say, well, I'm going to let the markets go, I'm going to blame the Biden administration for this, then you might take a huge financial institution out. You might blow up the Western financial system in the process of doing this. This idea you can manage these things is not like it used to be prior to 2008. I don't doubt there was times when markets were allowed to crash and because they overheated, but we have never had an overheated market since pre 2008. That's the whole basis of what 2008 is about. So this is just an introduction to say this is an unprecedented gamble. But what we thought we'd do is look at some of the uh, things that we are observing that kind of infer the markets are expecting this, and some of the data that might support the fact the real economy is cratering. Because remember, the stock market isn't the real economy. Bond markets are not the real economy. The real economy is what's affecting Americans out there in terms of their ability to keep their jobs, pay their bills, and the ongoing cost of living crisis that inflicts huge parts of the Western world.
Yeah, to put this all into perspective, let's go back to 2009. The Dow at its lowest was 6,600. The S&P 500 was at 666. That's an ominous number, but so be it. Ever since that time, of course, 2009, we started in 2010 when Bernanke brought in quantitative easing. And of course, we saw QE 1, 2, 3, Operation Twist, and then there was, of course, with Powell, the reverse repo. So for the entirety of that time, except for small little points on the chart over the last 15 years, we have had the Fed infusing primarily through financialization the markets with liquidity. Of course, it led to the inflation, but that's a different topic. But it led to inflation of asset prices. Now, go back to 2015. If you remember that QE2 was stopped and we saw the markets start to retract. So they had to bring in Operation Twist and vice versa. Every time the Fed would close the spigot, the market started to fall. Well, what is something that happened here at the end? The Dow reached its all-time high in December of 2024 at 45,100, I believe. We're now down below 40,000, 40,800. That's a 10% decline. But if you take into perspective that 15 years ago, when we were at 6,600, 45,000 is approximately 715% increase in 15 years. Talk about unprecedented. It took the United States until 1955 just to get back equal to what it was in 1929 at the crash. So in 15 years, we've gone up 715% in the Dow, and now there's a 10% decline, and they're acting like all hell is breaking loose. So that tells you just how leveraged everything is. And, interestingly enough, of course, is where in the past over the 15 years, when you had a 15% or a 10% and even a 20%, there was one 20% correction over that time. I think it was in 2015. The money was not going into gold and silver, it was going into treasuries because we saw the yield curve start to retract. But now the money is not going into treasuries, it's going into gold and silver. Now that's an entire topic unto itself, but there are so many things that are starting to unwind the margin and leverage of the paper markets. And we may discuss the dollar. Why is the dollar falling? Well, they reestablished the carry trade with the Japanese yen, and the yen is getting stronger, which is something the Bank of Japan doesn't want. So it's like all these things that have been held off for so many years are now starting to just crack. And I would be surprised, honestly, if Trump and his administration tried to paint it over rather than recognize, what? This is it. And we can either get ahead of this and use the blame for those who actually did it, or we can sit there and do nothing, say that the economy is great, and meanwhile end up taking the blame. So I think it's a very smart move to come out and recognize, hey, this is the way the situation is. We're inheriting it from Biden or whomever, and we're going to try to have some short-term pain in order for it to get rid of some of the toxic waste. And potentially what we want to do is XYZ and have long-term success.
Well, yeah, but it's doomed to fail because it's just, well, anyway, we're not going to go through what we did previously, but, you're gambling with the fact you have no way of knowing what the outcome is going to be in allowing it to crash, and B, your policy decision. But we'll talk about the economic side of things in a separate podcast. This is just, okay, what are the indications that the market might be going? And there's a lot of things. For example, if you look at the US junk bond market, you can certainly see that investors are walking away from it. Why? Because they think Trump's policy decision is going to cause economic turmoil in the US economy. So therefore, people will walk away from riskiest investments. And we've certainly seen, if you look in the gap between the borrowing cost between junk-rated companies and the US government, it's jumped considerably higher recently. I mean, and this follows this kind of switch in investor sentiment when there was people getting into junk bonds in a big way because they thought the US economy was getting stronger. Of course, it wasn't in reality. And all the record high for stocks, as Ken pointed out, in December of last year. But there are fears now of a US recession, all the uncertainty around the tariffs. And, therefore, on that basis, that is an indicator that the wider market sees a huge problem coming. Also, it's worth noting high grade US corporate bonds have come under quite heavy selling pressure recently. So that indicates investment grade and junk status bonds are under duress. The other thing worth noting, or one of many other things, is hedge funds are unwinding positions in single stocks at the largest amount in over 2 years. We're seeing the kind of things happening as we did at the onset of the pandemic 5 years ago in March 2020. And clearly, there's a belief that, as much as anything, this is a huge deleveraging exercise. But, if you see hedge funds selling single stocks to this extent, and they're taking these large deleveraging moves, why are they doing this? Because they see the writing on the wall. I mean, what's absolutely clear is I think it's not unreasonable to suggest that leverage across the board in the financial sector is as high as it's ever been, and particularly with hedge funds, where the leverage in relation to individual equities is probably at the highest it's been at least since 2000, the start of the pandemic. It's probably even going back further than that. And what we're seeing is this kind of desire to deleverage across all sectors in the global economy, or all sectors that people have investment risk exposure to, but actually more than anything in the industrial sector. And we're seeing it across all regions, but especially in the United States. So hedge funds are reacting, and other financial institutions. We talked about junk bonds and corporate bonds. It's also worth noting JP Morgan came out and said there's about a 40% chance of a US recession this year. But tellingly, they talked about a risk of lasting damage to the country's standing as an investment location if the Trump administration undermines trust in US governance. So, they say where we stand now is with heightened concern about the US economy. So JP Morgan have come out and made these statements. And I'll give way to you, Ken, and then, you can mention some points, and then I'll mention some more after that.
Yeah, there's four things that really stand out. You mentioned one of them, hedge funds unwinding. The second thing is that there's an old saying in investing or in making money. If you want to be rich, do what the rich do. Well, guess who was selling his holdings and his positions even before Trump took over? That was Warren Buffett. Everybody was buying in, feeling the euphoria, but he was selling. And he was, of course, being questioned by the business media. Why would he do this when everything is, looking like it's utopia? But he's now sitting on $300 billion in cash, and he's gotten out of a lot of his positions. The other thing is there are two banks that are eliminating some of their investment banking roles. One of them is Bank of America, and the other is Credit Suisse, which is officially retiring its Credit Suisse Securities LLC. And they're doing that in about a week. Finally, the last thing is the NASDAQ has halted its high-speed trading service. So they're trying to slow down all this front running that has been done by the major institutions, which means that the potential for headlines and jawboning and any types of those slight maneuvering, I won't say manipulations, but maneuverings done by the major institutions aren't going to have as much effect on the markets as they did in the past, where when a Fed head would come out and, just blabber whatever, the algos would run, accordingly. Now that's being halted, which means that manual individual trading is going to take precedent when it comes to the potential to sell off. And I think the NASDAQ sees this because the potential for, a really hard crash at any given moment, the flash crash is precedent when it comes to being run by these high speed algos and the front running. So we're seeing Wall Street in itself start making these changes and moves because they think they recognize that the party's over and the punch bowl is pretty close to empty.
Yeah, and the other points were, if you look at the US trade deficit, budget deficit, sorry, 1.1 trillion in the first 5 months, and there was a deficit in February of 307 billion, and the total outlays were 603 billion, which was actually 34 billion higher than the Biden administration in February 2024 year on year. So much for what Doge is doing. Okay, we argue it's early days, but I don't think anyone's believing there's going to be some huge cuts in outlays. The receipts, this is actually smaller than the deficit. I mean, this is an enormous problem. So everyone's looking at this going, well, how's the economy strong on this basis? You can see all this data that doesn't suggest the weakness that reality is unfolding. And then, of course, there is this thing where the dollar's got considerably weaker, and it was poised to have its worst week recently in over 2 years. It may be actually nearer 3 years. And why is the dollar, or traders souring on the dollar? Because they think trade policies are going to slow growth enormously in the US economy. I mean, and US job growth is kind of not performing how they expect it to be. Unemployment rates rose. I mean, and of course, this all points to the fact that the market and basically financial institutions are going, well, monetary easing is a given. And yields got lower in the bond market, so it weighs on the dollar as well. But generally, there seems to be weirdly this expectation that Germany and Europe's going to spend huge amounts of money they don't have, so the euro got stronger as well. But there's no doubt about it. The broader perspective is the perception is the dollar is going to get weaker, and this may also reflect upon the fact of why all these factors are suggesting, well, we're not exactly going to crash the market per se, but we're going to allow the market, we're not going to get in the way too much of it falling, crashing, whatever you want to call it. Problem is, though, we're back to this point, they have no control over this. And this is what financialization has done. This is what post-2008 has done. The idea, well, we can have a sort of crash, but it's a soft-ish landing, is like playing Russian roulette. They have no way of knowing what the outcome will be. And there's always this over-exuberance. I know this personally from 06, 07 and through 08. The idiotic exuberance, there's not a problem. Yeah, the data, well, I'm sorry, here's the data that shows we're going to have a massive crash. No one believed it. So there's that to contend with. But I think increasingly the market's becoming more wary of it. And then, of course, there's all the counter tariffs and the whole uncertainty around tariffs, where the European Union introduces tariffs on the 1st of April. Okay, frankly, it's a stupid move, but they're doing what they're doing because we have to be seen to countering what the US is doing. I mean, and therefore they took this swift, what they claim, proportionate action against US imports. I mean, and so, of course, this is just all going to create further weakening in the broader Western economies. And what happens in the European Union is going to certainly have an impact in the United States. The idea that everyone's an island, of course, is long since evaporated. So these are just examples where, and we don't want to go on and labour points about this, but when you look at the economic data, and okay, we had, apparently inflation falling, not rising as high as it was in the month of February. I mean, with annual inflation, it was supposed to be at 2.8% in February. But of course, all this data is manipulated. Inflation's far higher. And then we've had all this issue of when you look at payrolls and where the US jobs, the figures was the smallest increase in 7 months in February. I mean, and of course, these are all going to be revised much lower in the future because they always are. And there's clear indications that most of the jobs that are created are just service sector jobs in leisure, but they're not jobs that actually will truly benefit the US economy. That's been a long-term problem. But we're seeing job losses in key areas like trade, transportation, utilities, etc. So these are all indicative that the economy is in serious trouble. And in essence, the question is, whilst the markets are not linked to the real economy, if the markets capitulate, then it's not only going to blow up the financial system, it's not going to risk endangering even the too big to fail banks. But of course, then it's going to start to impact the real economy even more, because that's when the link between the real economy and the financial world will rear its head acutely. Because once you have a problem of a market crash and the financial institutions are in trouble, remember the whole economy depends on endless credit. No one's going to give credit. So then sectors in the real economy are going to start suffering. Big corporations will suffer. And it becomes this knock-on effect. And I think rather like there's a bit of an arrogance in the Trump administration, we're going to fix the US economy, we're going to make us an industrial powerhouse, and we're going to defy the laws of physics and maths in doing this. They think, well, we'll take the heat out of everything. And then they're probably in truth thinking, well, then we'll have an excuse for QE again. Then we'll have an excuse to slash interest rates because that's what they want to do. And then from that, the phoenix will rise from the ashes and we'll all be laughing. And, with the Trump administration set for the next 2.5 years, whatever it might be, and into the future when we want whoever's going to be president after Trump, maybe Vance, whoever knows. And this is their thinking, and it's this kind of hubris and exuberance. And they really are not understanding that they're playing with fire in just allowing the markets to crash or to correct in a huge way, whatever it might end up being. So I think, for me, Ken, that's probably a good point to stop. And then we'll do a subsequent podcast, which will then look at their policy decisions they're actually going to make and what's going to happen as a result of that. This is more just to indicate what's currently going on and why the markets are anticipating something, and the Trump administration don't appear to be wanting to get in the way of that.
Absolutely. Paul, as always, thank you for your insight and for being a part of this great discussion.
Yes, and likewise.
And to everybody here at the Sirius Report community, thank you, as always, for your support. Don't forget to like, share, subscribe, comment, send this out to anybody you think it might be important to. And until the next time we get together, have a great day.